I need to warn you about something that most gold and silver bulls do not want to hear right now. A flush is coming. I do not know if it happens next week or next month, but the technical setup, the macro conditions, and the historical patterns are all pointing to one thing: a sharp, painful, potentially scary drop in gold and silver prices before the next leg higher. And if you're not prepared for it mentally and financially, it is going to shake you out of the best long-term position you will ever have the opportunity to hold. I have seen this happen over and over again in this market. Bull markets in precious metals do not go straight up. They never have, and they never will. They advance in waves, 2 steps forward, 1 step back, sometimes 1 step forward and 2 steps back before the real move begins. And the flush, the sharp, brutal sell-off that feels like the entire thesis is broken, that is not the end of the bull market. That is the last toll booth before the highway opens up. Today, I'm going to tell you exactly why I think a flush is setting up right now. I am going to show you the historical context that makes this pattern so recognizable. And then I'm going to give you my exact buy levels, the specific price zones, where I personally will be adding aggressively to my physical gold and silver positions. Because a flush is only a disaster if you are not prepared for it. If you are prepared, it is the single best buying opportunity this market will hand you. Let us start with what is happening technically right now. Gold has had an extraordinary run. At the time of recording, we have seen gold push to levels that have generated enormous mainstream attention and retail excitement. And that is exactly the problem. When your taxi driver is asking about gold, when financial news anchors who ignored precious metals for years are suddenly talking about new all-time highs with enthusiasm, when social media is flooded with gold bull content from people who could not tell you what the gold to silver ratio is, that is not a buy signal. That is a warning sign. Sentiment in gold right now is stretched. The commitment of traders' data shows commercial hedgers, the smart money, the people who actually produce and use gold, are sitting on one of the largest short positions we have seen in recent memory. Commercial hedgers are not always right on timing, but they are almost never wrong on direction over a multi-week or multi-month horizon. When they are positioned this heavily against the retail crowd tends to get flushed out before the next real move higher. Silver is showing similar signals, but with an important difference that I want to come back to. Silver has not yet broken out the way gold has. Silver has been lagging. And that lagging behavior in silver, combined with an overbought gold market, historically sets up a specific and very predictable sequence of events. Gold flushes. Silver follows gold lower, but with more violence. And then, and this is the critical part, silver recovers faster and harder than gold when the flush is complete. That sequence is exactly what I'm watching for right now. Now, let me give you the historical context, because understanding the past is the only way to stay rational during a painful flush when your emotions are screaming at you to sell everything. Look at 2008. Gold peaked in March at around $130 an ounce. Then it flushed hard. By October of that year, gold had dropped to $680. That is a 34% decline. Silver was even more brutal. Silver went from $20 down to under $9 in the same period. If you were holding silver through that flush, your position was cut by more than half. It felt like the precious metals bull market was over. The mainstream declared it dead. The gold bugs looked foolish. And then over the next 3 years, gold went to $1,400 and silver went to nearly $50. The people who held through that flush or added at the lows captured one of the greatest precious metals bull runs in modern history. The people who panicked and sold at the bottom spent years regretting it. Look at 2011 to 2012. After silver's historic spike to nearly $50, it crashed back violently and spent several years in a grinding, painful downtrend. That was a full cycle completion, not just a flush, but it reinforced the same lesson. Positioning and patience determine whether this market makes you wealthy or breaks you. Look at 2020. When COVID panic hit in March, gold dropped 12% in 3 weeks, and silver got absolutely demolished, falling over 35% in a matter of days. If you panicked and sold your silver at $12, you missed silver tripling to $30 within 5 months. The flush was violent. The recovery was even more violent. The pattern is always the same. The flush feels like the end. It is actually the beginning. So where are my exact buy levels? For gold, I am watching 3 specific zones. The first zone is between $2,950 and $2,900. This is the first meaningful technical support level where I expect some buying to step in. If gold pulls back to this zone on normal selling pressure, I will add a small initial position, call it 20% of what I want to deploy. I'm not trying to catch the exact bottom. I am trying to buy in tranches so that if it goes lower, I have dry powder left. The second zone and my primary target for gold is between $2,600 and $2,700. This is where I expect real support to build. This level represents a meaningful retracement from the recent highs and aligns with several important technical confluences. If gold reaches this zone, I will deploy the majority of my planned allocation, roughly 50% of what I have set aside for this opportunity. At this level, the risk-reward for a long-term physical gold position is exceptional. The third zone, my max pain target that I do not think is likely but I need to be prepared for, is between $2,300 and $2,400. If macro conditions deteriorate sharply, if there's a credit event or a liquidity crisis that forces institutional selling across all asset classes the way 2008 did, gold could flush this deep. If it does, I will deploy everything I have left. A gold price in that range against the current macro backdrop would represent one of the greatest buying opportunities in the history of this metal. For silver, my levels are different and reflect silver's higher volatility and that lagging behavior I mentioned earlier. My first silver buy zone is between $28 and $30. Silver is already not far from this level as I record this. A flush back into this range would represent a healthy reset of the overbought momentum in gold and give silver a chance to build a proper base before its next move higher. Small initial position here. My primary silver target, the zone where I get genuinely excited and start deploying real capital, is between $22 and $26. I know that sounds like a big drop from current levels, and I know it sounds painful. But silver has done exactly this kind of correction multiple times in recent bull markets. A flush to $22 to $26 from current levels would be entirely consistent with historical precedent. And silver bought in that range, if this bull market plays out the way the macro fundamentals suggest it should, would represent extraordinary long-term value. My maximum pain silver level, again, not my base case, but something I am prepared for, is between $16 and $19. This would require genuine systemic shock, a 2008-style liquidity crisis, or a severe global recession that crushes industrial demand expectations for silver. If silver flushes to this zone, the gold-to-silver ratio would spike to levels that have historically preceded the most explosive silver recoveries on record. I would be an aggressive buyer at these levels with both hands. Now, I want to be very clear about something important, because I think a lot of people misunderstand how to use price targets like these. These are not predictions. I do not know if gold flushes to $2,600 or $2,400, or if it just dips to $2,250 and then resumes higher. Nobody knows. Anyone who tells you they know exactly where this market is going is either lying to you or lying to themselves. What I am giving you is a framework, a prepared response to a range of scenarios, so that when the flush comes, and some version of a flush is coming, you are not reacting emotionally. You are executing a plan you built when your head was clear. The biggest mistake investors make in precious metals is not being wrong about the direction. Most people who are in this market are right about the long-term direction. The biggest mistake is getting flushed out at the bottom because they did not have a plan, did not have dry powder, and did not have the psychological framework to buy when everything felt most terrifying. Markets are designed to transfer wealth from the impatient to the patient, from the reactive to the prepared, from the emotional to the disciplined. The flush, when it comes, will feel catastrophic. The headlines will be negative. The sentiment will turn bearish almost overnight. People who were bullish gold and silver last month will suddenly be posting about how the bull market is over and how they saw it coming. Social media will be full of told you so content from people who have been wrong about precious metals for a decade. That is the moment. That is when you execute your plan. I have my levels. I have my allocation plan. I have my physical targets, and I have my cash set aside and ready to deploy. I'm not hoping the flush does not happen. I am genuinely hoping it does. Because at my target levels, this is a generational accumulation opportunity dressed up as a crisis. Get your levels, build your plan, set your allocation, and decide in advance how you will deploy it across the zones. And then when the chaos comes, and it is coming, you will be the calmest person in the room, because you saw it coming and you prepared. That preparation is the entire game. Everything else is just noise. Build the plan, trust the levels, stay the course. I will see you in the next one.